A history book never announces the page you are standing on. March 9th, 2009 felt like financial ruin, not destiny. Screens were bleeding red. Retirement accounts looked gutted. The people on television were not whispering opportunity, they were broadcasting collapse. A teacher with cash, saved for a home down payment, looked straight at that fear and bought an S&P 500 index fund anyway. No hedge fund trick. No magic ticker. No secret memo from Wall Street. One decision, made while the crowd was emotionally frozen, turned ordinary savings into extraordinary wealth. That pattern matters more than the dollar amount because market history keeps rewarding the people who can recognize the difference between terrifying headlines and discounted assets. The noise in moments like that sounds intelligent. Wait for clarity. Wait for stability. Wait until the crisis is over. Wealth reality moves in the opposite direction. Clarity usually arrives after the prices are already higher. Stability usually returns after the biggest gains are gone. The market did not climb because fear vanished first. Fear stayed in the room for years. Europe shook. Washington stumbled. Trade wars erupted. A pandemic slammed the global economy. Inflation returned. Rates jumped. Every few months, the crowd found a new reason to believe the rally was finished, yet broad equities kept converting patience into net worth. Millions of regular people crossed the millionaire line, not because they predicted each event correctly, but because they kept owning productive assets while the headlines kept selling anxiety. Now the setup changes, but the mechanism rhymes. The next wealth surge is not being born from a market crash. It is being born from movement. A colossal amount of capital built over decades is beginning to leave one generation and pass into the hands of another. Think about the image for a second. Family homes, brokerage accounts, businesses, trusts, land, pensions, art, private holdings, cash balances, all slowly unlocking at once, not in one dramatic week, not in one clean headline, over years, over decades, over tens of trillions of dollars. People hear the phrase great wealth transfer and imagine inheritance checks landing in a few lucky mailboxes. The real story is bigger. Money that moves does not rest politely in a corner. It hunts for a new owner, a new asset, a new return, a new purpose. That is where most people misread the opportunity. They stare at inheritance like it is a lottery ticket. The more powerful play sits one layer deeper. Only a small slice of families will receive transformative fortunes directly. Most people will never open an envelope that instantly changes their lives, yet they can still benefit from the economic shockwave. Capital coming out of estates gets reinvested. Properties get sold, renovated, rented, or repurchased. Advisory firms expand. Tax planners get busier. Trusts get restructured. Heirs rebalance. Portfolios, new businesses get funded. Existing companies receive fresh demand. A river does not enrich only the person who owns the source. It changes every field it passes through. The smart observer does not ask, will I inherit a fortune? The better question is, where will the river flood next? Look at the contrast already forming. The market's noise says daily drama is everything. One inflation print, one jobs report, one political fight, one earnings miss, one panic-inducing chart. Wealth reality cares about long-duration forces. A multi-decade capital handoff can outweigh hundreds of short-term scares. The market's noise focuses on whether the next quarter looks messy. Wealth reality focuses on whether money will keep searching for productive deployment over the next 20 years. The market's noise obsesses over volatility. Wealth reality studies direction. When trillions need new homes, direction matters more than drama. A person who understands that starts to think less like a spectator and more like an owner. Ownership is still the center of the story. Broad equity exposure remains the simplest machine for absorbing long-run prosperity. People love complicated narratives because complicated narratives feel expensive, and expensive feels intelligent. The evidence keeps humiliating that instinct. A worker who automates monthly contributions into diversified index funds can outperform the person who spends years chasing perfect entries, miracle sectors, and cinematic predictions. Compounding does not care how exciting your strategy sounds. It cares whether money is invested, whether time passes, and whether productive assets continue generating value. The crowd wants a brilliant move. Wealth often comes from a boring one repeated hundreds of times. The emotional trap is timing. Everyone wants the clean bottom, the flashing green signal, the all clear from the sky. Those signals almost never appear in real time. In 2009, nobody knew it was the bottom while they were standing in it. People who bought felt reckless. People who waited felt responsible. One group got the rebound, the other got reassurance. Reassurance is expensive. The same trap exists now. There is no single entry point for a 20-plus year transfer of capital. No ceremonial bell will ring to tell you that the wealth wave has officially started. The early innings always look ordinary. Capital is already moving. Families are already restructuring. Assets are already changing hands. Waiting for perfect confirmation in a process like this is just another form of refusing to act. Sector leadership will shift because the hands controlling capital are changing. Older generations built portfolios around one set of assumptions: dependable blue chips, bonds, legacy institutions, familiar business models. Younger generations view risk and opportunity differently. They are more willing to allocate toward innovation, infrastructure, digital systems, specialized healthcare, alternative assets, and businesses closer to the technologies shaping their daily lives. You do not have to worship every trend to understand the broader point. When ownership changes, preference changes. When preference changes, flows change. When flows change, valuations, winners, and laggards change with them. A giant transfer of wealth is also a giant transfer of taste. Housing will feel this shift in a very human way. One neighborhood may fill with inherited listings as older owners pass properties onward. Another may see aggressive bidding as younger, better capitalized buyers chase a limited supply of homes near jobs, culture, and growth corridors. Same country, different outcomes. Real estate is never just about real estate. It is about population, income, aspiration, zoning, financing, and whether capital wants to gather in that exact place. The market's noise says housing is one national story. Wealth reality says it breaks into dozens of local battles. A detached suburban property in a slow-growth area and a townhouse in a city pulling in talent are not participating in the same future, even if they share a headline. Careers will be pulled into the wave too. The coming winners are not limited to investors and heirs. Money in motion creates work around itself. Estate attorneys, tax specialists, financial planners, trust administrators, appraisers, real estate operators, fiduciary experts, succession consultants, insurance strategists, private market advisors, even content creators and educators who can explain complex financial decisions clearly. These people step into expanding demand when wealth begins changing hands at scale. A person can profit from the era without inheriting a dollar, simply by building skills that help others transfer, defend, grow, or redeploy capital. In every major wealth cycle, there are asset owners and there are toll collectors. Both can do very well. Women are positioned to become one of the defining financial forces of this transition. Large sums frequently move first to surviving spouses, before reaching children or grandchildren, and that means a massive amount of decision-making power will be concentrated in the hands of women managing money at a scale previous generations rarely experienced. This is not a niche footnote. It changes how advisory businesses grow, how products are designed, how estate plans are structured, and which firms earn trust. Anyone building services for the future economy has to understand that wealth control is shifting not only by generation but also by household role. Industries slow to recognize that will watch smarter competitors take the relationship and keep it for decades. The most dangerous mistake from here is assuming the opportunity belongs only to the wealthy. That belief sounds humble, but it acts like poison. It convinces ordinary earners to stand outside the compounding machine while richer families keep feeding it. The 2009 lesson destroyed that excuse. Teachers, nurses, small business owners, accountants, engineers, tradespeople, and office workers built serious wealth because they participated. Not perfectly, not heroically, consistently. The person investing a few $100s a month can look insignificant in year 1 and powerful in year 20. Add employer matches, rising income, tax-advantaged accounts, and a macro environment shaped by trillions seeking productive deployment, and the math starts looking less like hope and more like inevitability. Picture two people living through the same decade. One consumes the market like entertainment. Every dip feels personal. Every headline becomes a verdict. They move to cash, back to stocks, back to cash, always reacting, always feeling informed, never giving compounding enough uninterrupted time to work. The second person builds a quieter system. Automatic 401k contributions, IRA funded, emergency reserves intact, broad market exposure maintained, skills improving, optionality growing, some cash ready for dislocations, fewer predictions, more positioning. 10 years later, the first person has memories of drama. The second person has assets. Contrast creates clarity. Wealth rarely belongs to the person who watched the C story most closely. It belongs to the person who owned the right pieces while the story unfolded. Action matters most when it feels emotionally unremarkable. Maximize the tax shelters you can reach. Own broad equities. Keep a long runway. Build reserve capital so volatility becomes an opportunity instead of a threat. Learn the mechanics of estate planning, taxation, real estate, or wealth management if your career can benefit from them. Talk with family instead of treating money conversations like a curse. Clean structures beat messy assumptions. The historic opportunity is not hidden, it is almost offensively visible. That is what makes it powerful and easy to ignore at the same time. Public information keeps creating private fortunes because most people would rather admire a trend after it works than position for it before it feels obvious. The deepest irony in wealth creation is that it never looks cinematic from the inside. It feels slow, it feels uncertain, it feels like repetition, it feels like buying while the world is nervous, holding while the world is distracted, and continuing while the world is convinced something smarter must exist. Later, historians compress that patience into a neat chart and call it a once-in-a-generation opportunity. People living through it experience something far less glamorous: doubt, discipline, boredom, volatility, and delayed gratification. The people who came out of the post-2009 era with 7 figures were not chosen by fate. They just stayed in the path of compounding while others stepped out of the road. This transfer of capital will shape markets, careers, housing, and business formation for years. Millions of people will talk about it. Far fewer will structure their lives around it. Some will inherit directly. Many more will benefit indirectly. The gap between those groups matters less than it seems because both depend on one principle. Capital rewards those already in position when it starts moving faster. The teacher who bought during panic did not need certainty. She needed courage and exposure. The investor living through this era does not need a prophecy either. The capital is moving. The handoff is underway. The question is no longer whether history is setting up another wealth-building chapter. The question is whether you are building a life that can absorb it when it arrives at full force.